thank you so much for having me here today, and hopefully you guys can hear me loud and clear. So, we're going to talk about the magic of options and how you can use this for income option strategies. That's something that I really like to incorporate in all of my trading. So it's going to be, what we're talking about here today is a 5-step plan for option income success. Step 1 is avoiding the option trading mistake, the number 1 mistake, and we'll go through that. Step 2 is the most important option factor. 3, how option pricing works. 4, knowing and using the market maker secret. And 5, the highest probability option strategies for every market. First off, the following webinar is purely for educational purposes. Any stocks, options, futures mentioned does not constitute advice and should not be construed as a recommendation. I've been actively trading for over 30 years and ran one of the largest oil trading companies in the world, ran their international crude oil trading desk out of Bermuda for over 10 years. And it was a fantastic experience for me, a really blessed experience. Learned a heck of a lot and got to pretty much trade. If it moved, we pretty much traded it. So it was a really great background and experience for me. And that's where I got introduced to trading options back in about 1987. We started trading options on cargoes of crude and got a passion for that ever since. And so went on from there and launched the over-the-counter option brokerage desk for PVM Oil out of London. And they're the largest privately owned oil brokerage company in the world, and another great experience to learn even more about options there. So we're going to talk a little bit here about options today. And first off, though, I'd like to get an idea from people that are here. I mean, how many of you want to be trading full-time for a living, but maybe you're just not quite there yet, but that's your goal and your mission. So if you just put a yes or a no, I'd just kind of like to get a feel. Looks like lots of yeses. Well, basically we all have to start somewhere, and I used to be exactly like everybody here in the room. Now, back when I was running the trading desk, the international trading desk, at the end of the day, we would always, look at our P&L, and if the losses were bigger than the gains, I'd be pretty pissed about losing money, but it really didn't affect me personally, and because it wasn't my own hard-earned dollars. So, I would still get paid at the end of the month, and if I didn't, blow up the trading desk, I'd probably get a bonus at the end of the year. But, once I went out and started trading my own account, it was a total different reality. The whole game really changed for me. And, basically because it's your money and it becomes much more personal. I used to come home from work from the trading firm, and my wife, Camille, she would never really question me each day about, well, how did you do, what was your P&L, things like that. But, she could tell by my mood if it was a bad day or a good day. But, once it was our own money on the line, she started asking me a lot more, put it that way. So, it is a different situation for each and every one of us. Now, trading, though, for your own account can be one of the most rewarding jobs on the planet. But you really need to stay educated about it. And one of the most important things I can say to everybody here today is that you need to just stay on top of what you're doing, stay educated about it, and it is a never-ending process. And I tell my members and clients, there's no perfect trader, there's no perfect system, and it's just a constant journey of learning. So, stick with it. Now, what I also wanted to say, and the real basic aha trading moment for me actually came when I started to incorporate income option strategies into my own trading. And this is what I'm going to be talking to everybody here today about. So ask yourself this: if you could add a new income stream now, would it change your life? And if the answer is yes, then do you have a plan to achieve that goal? Well, first off, let's go through the step 1, which is avoiding that number 1 option trading mistake. Now, option trading has many more advantages than trading stocks, but it also is a bit more complicated. And for somebody just starting out, it can be a little intimidating as well. Now, that's why, many investors will decide to begin trading options by just buying short-term options. Let's say in this example, short-term calls, especially those out-of-the-money options or calls where the strike price is above the actual underlying stock. Since it's following that similar pattern that we all kind of lean towards is buy low, sell high. But is this really the best option strategy? So let's go through an example, and perhaps this will show you that maybe you should also look at selling options. Imagine you're bullish on Facebook and it's trading at $65. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike price of $80. And in this example, that would be 15 cents or $15 per option contract. And why would you do this? Well, because when you look at it, you can just buy a lot of them. So when you do the math, and remember, one option contract controls about 100 shares of the stock or the underlying. So when you do the math, you say, okay, well, I could purchase 100 shares of Facebook at 65. That cost me $6,500. But that same $6,500, I could actually buy 433 contracts of the 80 calls, and that would control over 43,000 shares. Well, when you do that math, you're thinking, man, that is just incredible what I can do on such a small investment. And then you start thinking, well, what if Facebook went to $81 within the next 30 days, and those 80 calls were then at $1.05 or $105 per option contract? You do the math on that, and it says that you could make over $38,000 in 1 month on a small investment of $6,500. And you know, at first glance, you're really loving this kind of leverage. It's awesome. But you know, the thing is, don't let that fool gold or glitter, you know, fool you, because there's always another side of every story. So the one problem with short-term out-of-the-money calls is that, or options in general, is that you not only have to be right about the direction that the stock moves, but you also have to be right about the timing. Now, this really ratchets up the degree of difficulty. Now, to make a profit, the stock doesn't just need to go past that strike price, but it also must do so within a defined period of time. And in this case, those 80 calls on Facebook would need that stock to reach $80 within 30 days to make that profit. So you're asking the stock in this particular example to move more than 23% in less than a month. And in this example, and in options, we can measure this, and this would be like a 2 standard deviation move. So, you know, how many stocks are likely to do that? Well, you know, there are some that will do. We'll see them from time to time, the Teslas and these types. But in all reality, not many. So in all probability, the stock would not reach the strike price, and the options would expire worthless. So based on probability, and we can use what we call standard deviation for options, we can determine what that can be. And in this example, it's only a 5% chance that this stock would be reaching $80 by expiration. So in order to make money on those out-of-the-money calls, you either need to outwit the market or you need to really get plain lucky. So I don't know about you, but usually it's the other way around, you know, the old Murphy's Law. So if you do have something go wrong, usually it turns out not too good for you. So you don't want to rely on that. You don't want to rely on your luck. So being close means no cigar. But then you could say, well, imagine, then the stock goes to 75 during 30 days of its option lifetime. Well, you could say you're right about the direction the stock moved, but since you're wrong about how far it would go within that specific time frame, you'd still lose your entire investment. So, you know, based on this newbie option trader mistake, in my opinion, a better goal for every trader is really to select trades based on what provides the most consistent positive return and not necessarily the greatest or biggest return. And one of the best ways to achieve this is by using option strategies that take advantage of selling options for income generation. Now, by selling options, you are in essence, you know, selling time. And you can look at an option as kind of like a coupon that, you know, it must be redeemed by expiration date or else it's going to be no longer valid. And then the question comes, well, then how is this done and what's involved in this process? Well, step 2 then is the most important option factor for income generation. It comes down to time. Now, time, or we call it time value, this is used for trading strategies that take advantage of that accelerated time decay of an option going into its expiration. And option income strategies are very, very tied to the time value and the impact that it has on the price of an option. So what is this time value? Well, if you're not familiar with time value, it's basically in option terms, it's the extrinsic value of an option. It's the premium a rational investor would be paying over its current exercise value, which is the intrinsic value based on its potential to increase in value before it expires. And this probability is always going to be greater than 0. Thus, an option is always going to be worth more than its current exercise value. So, you know, a buyer of an option is going to be willing to pay a little bit more because they're getting that additional time, and the seller is going to want more premium because they're taking more risk to give you that additional time. So that creates the option price. So here's a kind of an example to look at time and how it affects the value of an option going into its expiration. So when you look at this graph, this chart here, you'll see that when you start out 120 days to 90 days out, your time decay in an option terms, we measure this by theta, is very, very small. It can be, you know, starting out like a penny a day, which is $1 per option contract. And then as you get closer in to 60 days out, 30 weekly options, that goes to $5 a day, $10 a day, and $50 a day until you're at 0 before you know it. So if you're constantly just all you think about is buying options, you're going to be really swimming hard against that tide as that time decay starts hitting you and you start getting closer and closer to expiration. So that's one good example of maybe you should also look to incorporate selling options. So then step 3 is that, well, how does this option pricing work, you know, to affect the price of that option? What's involved with that? Well, there are basically 3 components. The main components for value in an option is, again, time value times the implied volatility of the option times its intrinsic extrinsic value. Now, there are other components within that also affect the value, but these are the main core components that you're going to be looking at. And once you know these variables, then you're able to, you know, price an option and know the option premium you should be getting. So first off, you've got that implied volatility, and this is basically what the marketplace is implying the volatility of that stock will be in the future based on a price change of the option. And then the intrinsic is the amount the option is in the money, and the extrinsic is that price of the option less that intrinsic or the out of the money portion of it. So here's a table to kind of illustrate how that price action works. So again, you've got, this is on a weekly option table or series. You've got time value times implied volatility times its intrinsic extrinsic value, and that gives you your premium. And you can see here when you come in on a Thursday, you have a brand new series of options. It's got 100% time. And then I just kept the intrinsic extrinsic value here constant, so you can see how the math, you know, works through. And here you've got implied volatility at 300 times your 100% time times that intrinsic extrinsic, so it equals a premium of $300. Now you go the next day and you can see that you've lost 1/8 of the value, you know, just from one day. If the price goes nowhere, that option contract now is only worth $262.50. And when you come in, you know, on a Monday, you're already 50% of that time decay or time value is gone. And even if the implied volatility spikes to 800, you can see that it barely increased the premium of that option. So this again illustrates how important it is to know about time value and how it affects the price of that option, and if you're constantly buying, what that's going to do to you as an option buyer. And then step 4, this is a really important part of option trading, and it really is helpful for any trading, and this is what the market maker's secret, what they don't really want you to know about. And you know, broad markets, if you go back and you look at your charts, they will tend to have trends, or they'll trade in cycles, and they'll maybe go 2 to 3 weeks in a nice, you know, trend or cycle up. Then all of a sudden they'll start, you know, trading sideways, and they'll go in a channel for 70–80% of the time while they kind of regroup and, you know, get the energy back. So it's based on this sideways price movement that out of the money option buyers are going to lose approximately 68.2% or 70% of the time, which I'll show you in just a minute how that adds up. And the market makers, they know these statistics, and therefore they're going to tend to usually trade from the sell side. And it's this professional money selling, trading from the sell side. This is what you need to be thinking about and looking at, and try to think like a market maker. And once you understand why they're doing it, then it becomes a lot more clear to you, and it can help you in your own trading. And it's all based on the math. So market makers, they use mathematical market probability statistics for pricing the movement of an option to its expiration. So they use their pricing model, and there are the certain components that go into it, and that's what they put in, and that puts out the price premium of the option. And it's knowing these probabilities of the underlying security finishing within a certain range at expiration becomes the key to, when you're determining what options to buy or sell and what option strategies you want to use or implement in your trading. And these statistics forecast how likely it is that an option will fall within a certain price up or down by its expiration. And it's this statistical forecast which is referred to in option terms as the implied move of the option. Now, it's this implied move of the option is basically a theoretical plus or minus 1 standard deviation move of the underlying security. So this is how it works. So here, if you've taken any statistics, you're going to recognize that this is a normal distribution curve of series of data happening over and over. It'll tell you where, how often things will occur. And so it's based on these probability statistics that short vertical spreads, or credit spreads we call them, when used correctly, can provide a trader or an investor the greatest probability of success. And one of the best ways to generate a steady stream of income monthly is to do these type of vertical credit spreads, and it all comes down to the math of probabilities. So here's an example, and this is we use an example here of Google, and this is your distribution curve. Now, pricing of options always starts out at the money. So right here at the top of the curve, this is your at the money price. And the components that you're going to be looking at in your option model is that implied move. And in this example, it's going to be plus or minus 4% of this price that's at the money, and based on expiration, which in this example is 10 days. So what the market makers are telling you based on this model is that they're given a probability that Google will trade between $480, 4% down from that at the money price at this point in time, up to $520 by expiration. So it's going to fall between these two prices, and this is going to be a probability of 68.2% of the time, or 1 standard deviation. So almost 70% of the time, this price on Google, based on these statistics here, these inputs, will be between these 2 points and not outside of it. So if you're an option buyer and you're always buying, say in this example, 520 strike or 530 or further out, your odds, your probability of success goes down dramatically. The further out you go, the less likely you are to make money, and it's all based on these statistics of probability. Now, these are theoretical, but this is how the option pricing models work, and they're very, very accurate most of the time. So using this probability analysis, this provides traders a very useful trading tool to determine price targets and then use those targets to trade against. And it's free, which is the great thing with most option platforms. So it's based on this math, and the math of probabilities. You can see that approximately 70% of options bought expire worthless, and it's based on this that it's really a good idea for traders or investors to also consider selling options as well as just buying them. So, this added option strategy, it really can make a dramatic and very positive difference in your trading performance when used correctly over time. And remember that, trading is a business of probabilities, and to be successful, controlling risk and having consistent winning trades is really what it comes down to, when you're trying to win that race in trading. Now, step 5 then is selecting the right income option strategy. And the goal of every trader really should be, again, to select trades based on what provides the most consistent positive returns, not just that big return. And knowing the best ways to achieve this is by understanding and knowing what income option strategies are available. Now everybody here today is going to be, different. We're all going to have different capital trading accounts, different lifestyles, different times of day that we can trade. So you need to consider all that within what you're looking to trade and the income option strategies that you may want to try. And these are the basic strategies that are available that are the most commonly traded. It's the covered calls, which maybe you've done. You've got calendar spreads, diagonal spreads, long iron condors, and credit spreads. So these are the main categories. Now, what I'm going to be focusing on is the credit spread, because the credit spread is a strategy, an option strategy that you can use in any kind of market condition or environment, whereas the other ones are more geared to certain market conditions. So we're going to kind of focus here on the credit spreads, and this is my favorite one to be using. In the credit spreads, you've got basically three different categories here. You've got the bear call credit spread, the bull put credit spread, and the long iron condor. And the basic construction is very simple construction. The bear call credit spread is basically it's a spread, so you're hedged. So you're long a call while simultaneously short a call with a lower strike, and this is a bearish strategy, and I'll go through some examples to show you. And then you've got the bull put credit spread. This is a bullish strategy, so you're going to be short a put while long a put with a lower strike, and also in the same month. Now these are low-cost strategies, and they're defined risk, and when constructed properly, they can really give you an excellent premium collection type strategy to use. Now this is an example of a bull put credit spread, and you can see here that this was on wind, and it was trading right here about $207. So you could have bought the stock looking for it to go up, you could have bought long options, or you could have done this bull put credit spread. And you can see here this red line down here, you're selling the short put, you're buying the put below it, so this is your spread. And this is a $500 wide spread on this particular trade. Collected $130 credit that goes straight to your bank account. The difference is $370, so that's your maximum capital at risk. That's the margin. That's what you would lose if you did nothing. Now, if this at expiration is trading above that red line, which is the 187 put short strike, you keep that $130. It's a 35% return, and this was about a 15-day type trade. So that's a bullish strategy using a bull put credit spread. Now here's a bearish strategy using a bear call credit spread, and this is using the SPX, the CBOE 500 S&P, and it was trading down here at like 1988, and here was selling a 1 standard deviation above the 2045 call up there, buying the 2050 call as your insurance, collected $100 premium there, max at risk 400. If this closes below that red line there at expiration, that's a 25% return. And these are low stress type trades. That's what I like about them too. You've got a lot of cushion right there before your strike is threatened, and if you do nothing and it goes against you, the max you lose is 400. So that's a bear call credit spread. And here you can just see the beauty of it that I like is that when you're down here, you're not sure, you think it might be rolling over, but you're not quite sure. I like to do these trades because I've got some pretty good protection. It'd have to move a long distance before I start getting threatened there, versus if you're just shorting the shares or buying puts there, you have to be so much more exact on the trade. And then you've got the long iron condor, which is the combination of the two together. And so this is a combination of the bull put credit spread and bear call credit spread, and you can leg it by having these two different spreads. So this is a nice strategy. When you think the markets are going to just trend sideways, then you do both legs. So you'd sell above here, you'd sell your bear call credit spread here, sell your bull put credit spread down here, and you collect a nice fat premium. In this case, $150. Maximum at risk is the difference, $350. If it closes below the red line, above the red line, you keep it. It's 43% return, not a bad return on your money for market going sideways type condition. So you can see here, you sideways action, it's a great strategy. Now these are great when the market's sideways, and that's when I want to use it. And you can leg it. If it goes up and rolls over, you sell the call spread, goes down, rolls back up, sell the bull put credit spread. Now the thing I want to show you here is really interesting is the comparison between a regular two bullish strategies, and the strategy one is just buying directional calls, just the old traditional go long, and the strategy two is also a long strategy, a bullish strategy, but it's selling the out of the money bull put credit spread. So you're going to see here the difference between the risk of these two trades and how it affects your P&L if something goes wrong. So here's strategy one. Strategy one is just buying those long options. Here's at the money calls. This is again on win, and it's trading at $207. So you buy the at the money calls, $11.40 per option contract. That's $1,140. For one contract. Now, for some accounts this is a lot of money. Now it's defined risk, though. The most you could lose here would be $1,140, and you've got unlimited upside, which is the really nice part of that strategy. Now strategy two, though, costs you a lot less to get into, and it's selling a bull put credit spread, selling that 187, buying the 182 bull put credit spread. It's also a bullish strategy, and you'll see on the next chart that win was trading at 207 when this was put on, and this is like 9.5% below where win was trading. Now we're going to compare the two strategies and see how they work out. So here's strategy one. Now this is if you just bought those long options, and here is when the trade was put on at 207. Now win drops down, though, on the 8th and is trading down here at $196. So with that drop, now those options that you bought at for $1,140, you're now down on your P&L over $580, $583 down. So that's with it going down to $196. Now on the 21st, I'll show you it comes back up, and you're trading right now at 205, but you can still see your long directional options are still down $518 per option contract. So that's smart. That's the detriment, of the danger of those long kind of just directional calls or puts. Now here's the other strategy. This is the spread. This is the bull put credit spread out of the money. And this was put on at the same time, but instead of buying directional calls, you did the put spread. So you sold that leg, the 187, bought the 182, and you can see it's below that prior low, and it's way below that $207 where it was trading. You collected the $130 premium, and your maximum risk if you do nothing is $370. But all you have to do is close above that level there, and you keep the 130. So let's see what happens to this trade as the market falls off. So when the market fell down here on the 5th, right here, to 196, this strategy was down only $38.50 per contract, whereas that long call was down $583. Big difference there. I like that a lot better than being down $583. So here's the next strategy. I mean, the next day or 2 days or about 10 days later, when you're at 520 on 521, it's trading back up to 205. Now you're in the money. You're making money on the bull put credit spread, 78.50 per contract, but you're still down 518 on those directionals. So there's a big difference between your profile risk reward on that type of trading strategy. And the next one I want to show you, this is one of my favorite for certain conditions, and this is the in the money vertical credit spread, and I call this is a positive risk ratio. So you have a positive risk reward, not a negative. When you look at those out of the money credit spreads, you notice that your risk reward is negative. You're risking more to make your profit. But you've got to remember that the probabilities are more in your favor. That's why you're getting in return. But this is when you go in the money on these credit spreads, it reverses that ratio. I'll tell you how this works. This example is on Tesla, and this was August, a weekly option trade, so a very short-term trade. And this is an in the money bullish spread, bullish price target option strategy, positive risk ratio. Here's the trend charts. It was looking for a move to the upside, breakout, so I used targets for some other things, and I put my targets together, and then I put together this setup. And so here's the spread that was used. This was, at the time, 229. So did this based on my layout. I shorted the strike, and Tesla was at 229. So in the money was $11 in the money on the did for that 240 strike, $217.50. The difference. This is the key. Look how little money you had at risk. You had 30 at risk. So it's the difference. The spread was $250 less your of 217. That gives your max at risk 3250. Now, if on expiration is at 240 or higher, you keep the over 270, and that's a 606% return, or a non risk reward positive. So that's the thing that's so off. You can on a small account and you really reduce your risk. See how little 3250 debit. I mean, max 217 is your credit, max profit, and that's a 240, 230 bull spread. So here again is how it lines up, and on expiration, but a 590% return. These are within a few days. So really cool. Here's one more trade example. This is on Netflix, and this is a bear call in the money positive risk ratio trade. As you can see, Tesla was trading right here, right on that 382. When it triggered, it broke down hard. So you could have shorted it, but instead, on the front here, did a bear call credit spread, sold at 377.5. Right there, bought the 380 as your protection, received credit here, $42 credit. The max at risk was the difference. The next day it dropped, and the credit was at 25, so just bought it back, almost a day trade. Very trade. Made on this 117% overnight. So it's a great, trading strategy, very low risk, and it doesn't take a whole lot of capital. So a lot of time to go into detail about everything, but these are the kind of things that you should consider, with your trading. Combine this with my, going directionally long as well. So I kind of basket. So I'll incorporate these credit spreads along with just buying options, and I'll together to divide my risk. So I want to get into a few questions before I run out of time here, and watching the chat box, a lot of good ones in here. But first I'd like to say just thanks for having me here today, and letting me share some of my trading knowledge and experience with you, and hopefully what I've showed you will kind of open your eyes as to other ways to look at trading and the potential impact it can have for your profitability. And again, like a lot of you, I've spent many, many years and a lot of my own money figuring out what I know now. And what it basically is for me is that slow and steady is what really wins the race in trading. And by me incorporating options into my trading, I've been able to be much more consistent and profitable, and a lot less stress for my trading. So I know a lot of you here don't know me at all, and I'd like to share just one quick email that I received from one of my clients, just kind of give you an idea of what I offer to my members. So take a minute to do that, and then I'll get into some questions. So let's take one more thing to talk about here, and then I'll answer your questions. But I want to offer you a simple way you can get started now to kind of start using these type of income strategies. And so this is a course I did recently, and it was a income option course, and it was 100% on credit spreads for income. Now this course, turned out it was a 5-hour course. It was recorded, broken down in 30-minute modules, recorded modules. You'll also in this course get the 183-page PowerPoint manual, which is very detailed, lots of examples showing you how to set up and do all these type of trades that I talked about here today. Now, if you're interested in this, let me give you the link real quick. Thanks, Reed. You already stuck it in there, so appreciate that. So just put in powercycletrading.com/PICK. It's $97 today for everybody here in the room. And if it doesn't work for you, it's a win-win, because I'll just send me an email and I'll give you your money back on that. Now, the other thing here, you'll also get, for the first 30 that sign up here today, you'll also get a live follow-up accountability and support Q&A that we're going to have in about a week or 2 weeks. So once you go through this course, then you'll have a chance to come in, ask me any questions regarding the course and the details within the course itself. So it's a really great way to learn the material, and then you have access to me to answer the questions. And if it doesn't work, just send me an email and we'll refund your money. So what is covered in the course is credit spreads, how to use them to create that low risk, those high probability trades. How to use credit spreads on stocks and index options such as the SPX, NDX, RUT. I love to use them on these type of index options. And how to use the non-directional credit spreads, when to use those things. And then how to set up these deep in the money credit spreads and when to use them, and what's the best way to set your target prices on that. So this is all covered in the course. And it's really great for taking a small account and turning it into a large account, with consistent trades with low capital at risk, which you can see from that couple of those different examples I showed you. And then I've got a big part of the course is defensive strategies. There's 6 defensive strategies that we go in great detail how to use those, and then how and when to use iron condors. It's not something that you want to use all the time, but we go in and tell you when and what's the best time to use those. And position sizing, I touched on that. It's a great way to reduce risk if you know how to use it for position sizing. And then how to turn a 70% probability trade into 90%. This is a really cool way to increase your probability of winning. Go through that. And guidelines for executing your trades, and talk about technical analysis. We use a lot of Fibonacci, so we go through using that as well. And the best time to set these trades so you don't have to be staring at your screen all day. So here again, it's just go in and copy and paste this link into your browser, and there you go. And then you'll receive an email as soon as we schedule that follow-up Q&A. So hopefully this will get you started for the new year, and some really great ways to consistently make positive returns for you. And let me get into a few of these questions before my time runs out. So high volatility, if I sign up, would you get some trades for today before the 4 p.m.? Wow, that's put me under a lot of pressure. I don't think I have time for that right now, but you're welcome to sign up and come into my trading room, and we can show you some good trade setups then and there. The course was recorded, so it's as soon as you sign up for it today, you'll get access to the digital recordings, and so you can get those, and it's yours for as long as you want it. And then you'll get the PowerPoints, which are a really detailed manual based on using these credit spreads. So it's a 5-hour course, and it's 100% on credit spreads, all the at the money, in the money, out of the money, all the options statistics that you need. We go in great detail on how to use the implied move of the option, how to figure that out, calculate it, set your targets. Very, very detailed course, but step by step, so it's easy to follow. Even if you've never traded options, you can go through it, and it's a very, very step-by-step type process course. Plus, the price point is such a nice level that if you're looking to get into options, this is a great way for you to get started. Well, thanks, Christopher. Christopher says this is the best presentation today. I appreciate that very much. That makes my day right there. What charting platform? I use Thinkorswim, and I also use TradeStation. But my trading model that I've developed and I use is I've got it coded and it's set up to use for Thinkorswim, TradeStation, NinjaTrader, and eSignal. John asks, how do you correct if the price does not go as predicted? Well, in this course, there are defensive strategies that I've designed, and those are taught in the course. So if something does go wrong, this is a big part of the course, is teaching what to do and how to use defensive strategies to make sure you don't lose that credit, or at least lose less than your potential at risk. You never want to lose that 100%. So these credit spreads are based on that, and also then how to defend that. That's all laid out in the course. What happens if the short calls or puts are in the money, but the protected puts are not? Well, you have to close these spreads out before the expiration, so you're not exercised. So that's the way you do it, and it's explained in the course. Now, you might think that you could get these things exercised on you, but what I like to do is use high beta type stocks, and I'll usually get out of them the day before expiration, but they're usually never exercised because there's too much extrinsic value still left in it. Plus, you get a lot of what they call gamma risk into the last day of expiration, and if you're long these options, you don't want to take that risk of getting, exercising them too early and then having that risk. And then question of how to project exit targets. Well, that's the beauty of the options with the implied move. You use the implied move to give your projection of targets for exits. So what that basically is telling you, the implied move, is how far up or down the option makers are telling you the probability is that that particular underlying will go, and then you set your outside targets based on those levels. What I usually will do then is set my inside profit target, my targets for actually profit inside of that, so I have either even a higher probability of that thing working out. Here's another one. Okay, if you trade by buying options, how far out would you suggest secure enough time to avoid that time decay? I will typically, if I'm going to buy options, I will go at least 30 days out. Not all the time. I mean, if it's a really high momentum type trade setup and it looks good as far as cheap premium, I will go ahead and buy. But in normal rule of thumb, I will go 30 days or more out to give me the gift of time, so the theta decay doesn't hurt me too bad. Let's see here. As far as money for opening accounts, these are all going to be subject to different brokers, so you best ask your broker that. Oh, okay, Christopher, you're in. That sounds great. I'm glad you signed up. Thanks very much. Yeah, in the first 30, I keep these, courses to pretty small groups, so I'm, able to make sure I'm able to answer all your questions. So this is a big part of the learning process, to be able to come to this follow-up Q&A. Helene, yeah, you're in. You're in. Yep. So you're into one of the 30 group here. So once we get to 30, though, I like to close it down to keep the group small enough. The bonus to sign up today is you get the follow-up Q&A, which is a coaching session basically. So you get to come in, and if you have any questions regarding credit spread course, the defensive measures, anything within the course that you're not understanding, it gives you time to come in and ask those questions. Yeah, and if you try to get the technical trading, it probably did register, but if you don't get it, a receipt for it, Helen, just send an email to support@PowerCycle Trading. We'll get that fixed up for you. Let me give you that. And let's see. So if you have any questions on that, on your order, you can go there. And I think I'm about out of time, but I really appreciate everybody being here today, and thanks for giving me this opportunity. Thanks, Reed. Appreciate it very, very much.